All right, this class is being recorded. Today is Wednesday, October 11th. So as we get started, here is the sign-in sheet. Make sure you sign the sign-in sheet today. All right, quick check-in on the Bloomberg Trading Challenge. Ends 1 week from today. This is for Section 401, the current rankings. If it were to end today, this team would get 5 points, 4, 4, 3, 2, 1. Okay? Obviously, it doesn't end today. We have another week before it ends. Very, very important. Every team to qualify has to have at least 10 longs. Everybody in this section has met that criteria, so that's good. Also, you can't have more than $300,000 of available cash. Currently, everybody's meeting that criteria. Make sure you continue to meet that criteria. Don't liquidate your portfolio Tuesday night before the game ends. All right, that will be very bad for you. All right, so just treat it like another trading day, and just like now, we're going to look at your portfolio value to determine the rankings for the first half. All right, any questions about the trading challenge? Again, approximately 5 o'clock on October 18th is when it will end. I'll take screenshots at the end of the day of those positions. Okay, great. So today, what we're going to do is we're going to work on building a reusable valuation model. You're going to need to go to the Files folder on Elms, and I created a folder called Nvidia, and in that folder, there are these 2 Excel files. You're going to need to download and open both of those Excel files today. Okay, so in the last section of the day on Monday, 3:30, one of the students came up to me after class and said, Professor Perfetti, even though no one during the day told you that they were struggling with Homework 7, I know a lot of people, including myself, were struggling with Homework 7, and she made an impassioned plea to basically give the model out rather than to use Homework 7, which people weren't sure whether it was right. So I agreed to do that, and that is what is in the Files folder. Okay, so the Files folder is the framework for the reusable valuation model. Okay, it's very similar to what you did in Homework 7 with a couple of nuances that we are going to talk about in a minute, right? But as I said, as we build a reusable valuation model, you are going to, for the next 2 weeks, and with an asterisk, this week, Monday, you have your group projects on Tesla. Wednesday, you have the midterm exam, okay? Following Monday, we're going to pick up on the valuation model, which we're going to start building today. Yes?
Just making sure it's on Tesla this month?
Tesla. I switched.
Okay.
I switched to Tesla from Amazon. It's Tesla. Okay? The data I gave you is for Tesla. So you do Tesla, not Amazon. Okay? So back to this. Next week, we're not going to continue working on the model, but this week, today, we're going to start. And then the following week, we'll finish, keep working on it, evaluation, and I've chosen Nvidia as the common company that we will all value, all right? Mm-hmm. So what we're about to do, you're going to follow along and do exactly what I do as we build out the Nvidia evaluation. Those will be your next 2 homework assignments, okay? You'll turn in files that match mine, okay? And if they don't match, you're not going to get credit, all right? And so it will take us 2 weeks to build the Nvidia reusable valuation model tied to Bloomberg. Once we do that, it'll take you 10 minutes to do any other company, okay? And so that's the point. During November, we'll be doing a lot of different valuations and a lot of different companies, and your next group project is going to be different this semester than how I did last semester. I'm going to give you an industry, and you're going to pick a company in that industry to value. So unlike previous group projects where everybody's doing Tesla, I might say autos, you could do anybody. One team could do BMW, another team could do General Motors, another team could do Toyota. You can do whoever you want, okay, as long as you're public. So you will have 6 different companies doing 6 different presentations on 6 different company valuations, okay? That's going to be group project number 3. In order to make all that work, we all need a reusable model. That's what we are about to build. This is the raw materials to build those models. You need those 2 files. Okay, questions about that? All right, so let me just tell you for a second what's different about the file I'm giving you versus Homework 7. Okay, they're very similar in structure. Okay, so I'm going to start out with this valuation model. So same idea as you, download it, save it. This is a file based on Starbucks, which is the valuation I did this summer with my MBA students. Okay? Except it has a couple of extra tabs, right? So here are the tabs in the model that you built. This was the standardized income tab with Starbucks data. This is the standardized balance sheet tab. This is the change in equity tab, historical data. This is the, and you would have appreciated this part, the balanced TFI mapped, okay? This is the balanced TII for every year mapped, and the balanced CFI for every year mapped, and the auto-generated ROIC tree, okay? So this is essentially a completed homework 7, just with Starbucks data that is correct, okay? And I told you this is the basis for our valuation model. I was being honest with you on that. Here's what's added, okay? So that we can do any company, there is a new tab called Model Data, okay? And this tab comes from Bloomberg. So we are tying our valuation model to Bloomberg and Bloomberg's database of companies. So here's the point. On this new tab, which was not in your homework 7, it's in this file called Model Data, it has 6 years of historical data for Starbucks from the income statement, balance sheet, and cash flow statement, row by row, from row 6 all the way down to row 80. Okay? These raw fields are mapped to our common income statement and our common balance sheet. Okay? So that if I give you another company, Nvidia, with this raw data and put it in, instantly it would have Nvidia's common income statement and balance sheet, and all the statements would immediately balance historically. Okay, that's the idea of the reusable model. So the way we're going to reuse the model is we're just going to update from Bloomberg this model data tab. Matter of fact, if you took the Tesla data from Bloomberg, put it in, your Tesla assignment would be ready to go. All you'd have to do is copy the statements, and your presentation would be ready to go. Okay, so this is the reusable model, right? So we're not going to finish this part today, but this is going to be part of your future homework assignment. I want to show you where this model data is coming from. Okay? So in Bloomberg, and I've just decided Nvidia is our company because we talked about it earlier this semester, it's a $1 trillion company. Let's try and figure out why they're a $1 trillion company, right? But you go to the company, Nvidia, US equity, and then you go to FA, which is historical data, okay? And then we go to custom. And the nice part of custom, if you create a custom, is you can look up any historical data that you want, okay? Now, the second file that I gave you is we are going to export custom data, and you're going to save a custom template that looks like this. Okay, so this template has all the data we need for any company. Right now it's populated with Nvidia's data, okay, for 6 historical years. Okay, so you're gonna have to create this template. Before I export this to Excel, I need to make sure I have 6 historical years of data. So I'm gonna go to my settings, you might as well do this now if you're in Bloomberg, and where it says number of periods, yours is going to say 10, change it to 6. Because our model wants 6 historical years, not 10 historical years worth of data. And if you try and export 10 historical years and put in our model, it will break the model. So 6 years. The other thing is the second tab under settings is data. You want to make sure all 4 of those boxes are unchecked. Because if those boxes stay checked, when you export 6 years of data, it will add some extra columns. And if we try and take extra columns into our Excel model, it will break the Excel model. We only want 6 years of data. We don't want Bloomberg to give us any extra columns. So uncheck those 4 boxes. Then hit update. That'll save it uniquely to your account so you are ready to export historical data. Okay? And then finally, with Nvidia's historical data, you would then go export to Excel, the current template, and in just a few seconds, it will take all this data and it will dump it into Excel. So there is any company's, in this case Nvidia's, 6 years of historical income statement and balance sheet and cash flow data, row by row. Okay? All filled out for us. Now here's the point. Do you see in the top row of my Excel file, it says Bloomberg? The way it's actually able to do this is because there's a Bloomberg for Excel add-in. And because I have an open Bloomberg terminal that I'm logged into, Excel with the add-in will pull from the Bloomberg database in real time to Excel. It's one of the very cool features of Bloomberg because I don't actually have to work in Bloomberg. I can actually work in Excel. And I can take any field in Bloomberg and put it into my Excel model, and every time I open up Excel, it will pull Bloomberg in real time and auto pull down the data. So for example, if I want Nvidia's current stock price, if I want the current analyst recommendations, if I want the current forward earnings estimates, I could literally just do it in Excel and pull out my Excel file and boom, instantly pull data from Bloomberg that's real time into Excel without ever going into Bloomberg. That's a very, very cool feature that you can't use. Okay? And the reason why is because you have to have that add-in in your Excel, and that add-in has to have your login to an actual Bloomberg terminal, which you're currently connected to. Because, I don't know if you noticed this, when I exported the data, it wasn't numbers initially. Okay? The numbers started to fill in. Because if you actually look at this file, 2023 revenue is not 26974. This field is a long formula that says pull the Bloomberg database for that cell and display that result. Here's why this matters. If I were to take this Excel file, save it, leave this lab, and try and open Excel on another account, it would error out. It would have no numbers in it. And if I tried to submit that as a homework assignment, I'd get a 0 because the TAs would open and like, what the heck is this? You gave me a bunch of garbage. Okay? So the only way this works is if you're connected to a Bloomberg terminal in this lab with a Bloomberg Excel add-in that is currently logged into a Bloomberg terminal that you were logged into. It doesn't work outside this lab for you. Okay? So this is why I will tell you it will take you 10 minutes to build our reusable model rather than making it instantaneous. Like if you all had your own personal Bloomberg accounts and spent the $25,000, then you could literally do this at home, okay? And you could set up our model, so you just type in a ticker symbol and boom, the whole Excel file auto updates. It's really cool. You can't do that. Here's what you can do. You then take this file that you just exported, you select this, whole tab, you copy this whole tab, on the file that you exported, you select it again, you paste special values. So basically what I've done is I've turned all these formulas into numbers. Now when I save this file and I open it up anywhere else, it'll open because they're numbers. But it's no longer tied to the Bloomberg database. This is why it'll take you a little longer to value another company using the model that we're building, because you'll have to do this step every time for whatever company you're doing. Does that make sense to everybody? But there's one additional step I need to make you aware of. Do you see right here where there's a dash for income or loss from affiliates for each of those 6 years? Okay. Feature problem of Bloomberg. Call it a bug, whatever you want. When Bloomberg doesn't have an item, which is essentially a 0 because it doesn't have it, it puts in a dash sometimes. So rather than put in a 0 for a missing item, it puts in a dash. Okay? So a dash is basically a 0 as far as you're concerned. But that's a problem in Excel because any formula in Excel that you use that refers to a cell that has a dash in it will error out. So if I were to copy this file, which we're about to do, into our reusable valuation model, it would break our model because of all the dashes in this file. It just wouldn't work. It errored out. You get all these errors. So step number 2, you have to turn these dashes into zeros. So take the dash, copy a dash, find the dash, find what the dash, replace it with 0, replace all. I've just replaced 46 dashes with 46 zeros. Those are the 2 steps that you need to do every time you export data on this valuation model. Does that make sense? So once you've done that, File, Save As. The file that I saved as was called Nvidia Data. That's the file that's in Elms, which I did in the 11 a.m. section today, that I put in the files folder. That's the one you need right now. So that's the whole point. It's raw data coming from Bloomberg. Okay? So here's how we're going to update our model. I have a Mac, which means there's 2 versions of Excel on my computer. This version of Excel, which is a Windows version, has the Bloomberg add-in. My Mac version of Excel does not have the Bloomberg add-in. When I open up the Mac Excel, which you notice Bloomberg's not on the menu anymore, there's the Nvidia data. That's the one that we just downloaded from Elms. So I have 2 files open. File number 1 is the Nvidia data that was exported 6 historical years. File number 2 was the model you downloaded called Valuation Model Start Nvidia, NVDA. And the data that's currently in that file is from Starbucks, okay? Because we did Starbucks this summer in my MBA class, all right? I gave them the same file. So here's the point. We're going to take the NVIDIA file that we just downloaded. We're going to select all of it, click on that tab, corner tab, copy it. We're going to go to the model. This is now following along. You should be doing this. We're going to go to the valuation model that you just did, model data, select the whole tab, right click, paste special values. And now the NVIDIA data, real time, is in this model. So we now have NVIDIA. So now, because this tab is mapped, this is all the historical TFIs for NVIDIA. This is all the TIIs for NVIDIA. And this is all the balanced CFIs for NVIDIA. And this tree is the NVIDIA tree. Okay, this is what you did for homework 7. It's just automated. Okay, and so what's automating it is that first tab of all that row by row data. Does that make sense to everybody? Everybody following along on that? Okay, so the other thing I want you to be aware of is sometime in the next 2 to 3 weeks, you're going to have to basically create in your Bloomberg account the ability to export data. Because after we finish NVIDIA, I'm going to say, pick a company. I don't know, BMW. Go value BMW. And that's it. That's all I'm going to tell you. It's your responsibility to do all this. Okay? So you're going to need that exportable data file. All right? So here's the thing I need you to be aware of. In the file, I exported from Bloomberg. Notice here it goes column A, and then it jumps to column C. Okay? Now, in my version, column B, your version, it's hidden. In my version, it's unhidden. So select column A and C, and then right-click and then hit unhide. And then column B will pop up. Okay? Because column B is there. It's just hidden on the file that I uploaded dumps. All right? I've unhid it in the 11 a.m. section. So unhide column B. All right? The reason why I'm unhiding column B, and this is very important, column B, you see these names? Sales underscore rev underscore turn, IS underscore COGS to fee and PP and G. Those are the names of the database fields in Bloomberg for every one of those line items. And they're very important because they never change, because this is used by Wall Street. All right? If you're Goldman Sachs, you never want something in Bloomberg to ever change because you're going to build all those Excel models tied to Bloomberg. Okay? And so that's the point. Anytime I export data, it's going to export it from those exact database fields. Those are the actual database fields in Bloomberg, column B. Column A are the friendly names of the database field, which can change company by company. So for example, I work with a company called Linda, which is a British company. And if you were to export their data, revenue would be called turnover, because they call turnover in the UK. Okay, so column A would say turnover. Column B still says sales underscore rev underscore turn. So what Bloomberg does is they will change company by company column A. They will never change column B. And they'll just map it. Okay? What's important to our model is column B. Okay? I don't care what column A says. Column B is the model is built off of column B, because if you go to the income tab, revenue, which is B3, is model data C6, and model data C6 is that year's revenue. So this is very important. If we're going to map it, it's got to map out exactly. So I need that to always be revenue. If that row is not revenue, my model will break. Okay? So this is another assignment you're going to have to do. You're going to go back to Bloomberg. You're going to go to FA Custom. You're going to go to, once you're in FA Custom, you're going to create a custom template, which now is only 6 years worth of data. And you see where this says enter field? This is the easiest way to do it. Take you 10 minutes. You go to your Excel file, take row B6, sales rev turn, copy it, go back to Bloomberg, enter field, paste it, select revenue. Go back to Excel. Sorry, I hate this mouse on my laptop. Take cell B7, which is cost of revenue, this really weird name here, copy it, go back to Excel, or sorry, Bloomberg, paste, well, copy and paste for some reason, go back to Excel, cost of revenue, copy, there it goes. Go to Bloomberg, paste. It's usually the first one, select cost of revenue. Repeat 78 more times. Okay? And just do it based on column B. All right? In that exact order. If you mess up any of that, it will break and will never work. Okay? So you need that exact file in that exact order. All right? Once you've done that 78 times, you will create the template that's reusable. But by the way, when you're doing it, after you add one, hover over it and just make sure that you selected the right one. Because notice when cost of revenue was put in there, there were several ones below it. If you click on the wrong one, because a bunch of things look the same, it won't map to the right database field. Right? The way you know you mapped to the right database field is you put in the database field, and then you saw the name, and then you selected it, and you verified that you selected the right one by hovering over it. That's the important process. I will tell you, for some bizarro reason, when you do this, every now and then you'll put in exactly what I did, and Bloomberg will say, I can't find it. It'll say, I can't find this database field. It's there. I guarantee it's there, because I just exported it. But it'll tell you can't find it. If you do run into that situation, put in the friendly name in column A, and then select it. And then hover over it, make sure you selected it, and then it'll get you to the field. It's a flaw in the Bloomberg software. We've reported as a bug. They've never fixed it, but nonetheless, it will happen from time to time. Okay, so it's not that their database is not there. It's just sometimes the search can't find it. All right, questions about any of that? Once you created the template, you'll save that template into your individual account, and you'll need it to export company number 2's data, and 3 and 4 and 5. All right. But picking up for where we're going to go today, we're going to go back to our Excel file, which now has Nvidia in it, and we're going to build out the valuation. So everything that I do from this point forward, including putting the data in, you are going to do. Okay? And you're going to have to match exactly what I do. Okay? So a couple of best practices. We're going to forecast Nvidia to do a forecast of DCF. So the first thing we're going to need is we're going to need forecasts of the income statement and the balance sheet. So here is one of the best practices we're going to follow. When you forecast ratios. You don't forecast numbers. The ratios create the numbers. So that's why under the new tab called ratios, this didn't exist in your model, these are income statement and balance sheet ratios. All as a percentage of sales, which the only one that's not is the revenue growth rate, which is a percentage change. But these ratios are all percentages. So here's the idea. These are 6 years of historical ratios. Based on those baseline ratios, we will forecast ratios for Nvidia. Based on the forecasted ratios of Nvidia, it will create the income statement and balance sheet. So this is one of the critical tabs for forecasting. The other critical tab for forecasting is called assumptions. These are universal assumptions that will help us build our valuation model. One of that is WACC, as an example, that we'll put into the model, okay? The difference between the ratios tab and the assumptions tab, where we're gonna put in some forecast numbers, is ratios are year by year, they change. Assumptions never change. They're universal. That's why they're on two different tabs. But that actually leads to best practice number 2. When you build a reusable model, okay, you want to minimize the places that you actually put in items that will change across the companies, right? So let's say that I am doing Nvidia and my next company is BMW, okay? If I put in changeable assumptions in the income statement tab and the balance sheet tab and the CFI tab and all the other tabs, and it's something I forget to change that was hard-coded for Nvidia, that's now locked into my BMW model, my BMW model might not make any sense, and I'm gonna go crazy saying, what the heck? Why doesn't my numbers make any sense? Because I have some leftover data from a previous company that's messing up my forecast. It's very, very common. So I'm giving you a universal best practice. Minimize the places where reusable data changes. So that's why we're putting it in these two tabs. If it's not in these two tabs, we're not going to change it across the models. Everything else will be a reference or a formula, okay? These are the models that will change. And you'll notice these cells are yellow. I highlight the items that can change using a color. Now the color I have chosen is yellow. If you don't like yellow, you can pick whatever color you want. But the whole point is, if it's yellow, it tells me that that's something I could change without breaking my model. Once we finish the model, if it's not in yellow and I change it, it could literally break my model. And I want to make sure that I don't break my reusable valuation model, because the same thing's going to happen. When I then do another company and I've broken my model because I've hard-coded in a number over a formula, and I'm like, why doesn't the EBITDA for BMW ever change? Why does it make sense? Oh yeah, because I overwrote something I shouldn't have. So 3 things: we forecast ratios, we minimize the places we forecast, in this place to only ratios and assumptions, and the items that we change across the companies, we put in a color, in this case yellow. Those are the 3 best practices we're going to use as we start our evaluation. Questions about any of that? Okay, so now, following along, let's forecast Nvidia's financial statements. We're going to start out with the ratios. Starting in column H1, this is my forecast. So I'm going to write the word forecast. For column H3, my first forecasted year is equals previous year plus 1. So H3 equals, or H2 equals G2 plus 1. 2023. Again, relative reference. Don't hard code in 2023. Everybody see that? But here's an important assumption. If I go back to my model data, the latest year is actually 23. It's not 22. So last year was actually 23. It's not 22. Okay? Because Nvidia's fiscal year ends in January. They're non-standard. Many companies end in December. Nvidia's fiscal year ends in January. So Nvidia is technically in fiscal 24 right now. My model doesn't say that. My model says 22 as the last historical year. So under the assumptions, last reported year, 2023. Hit enter. Then I go to my ratios. That's ought to have been updated. Everybody see that? Now for Nvidia, my first forecasted year is 2024. If I go to another company that ended December 31, the first forecasted year is 2023. So the way you'll know that is you'll go back to that model data Excel, and the last column is the last reported year. Just always check that, and then if you need to update the year, change the assumptions. Okay? So we have to update it for Nvidia. All right, but you might have to change it back when we do a future valuation. All right, so here's how we're going to forecast. For cell H3 equals cell G3. And then we're going to make that yellow. So basically, the revenue growth rate for 2024 is the same as the revenue growth rate for 2023, the actual. Now, we're just going to assume it just repeats itself. So as we build the model, we're going to assume that 2023 just repeats itself 6 times. All right? Now, I know that that's not realistic, but this is the placeholder so that when you turn in your homework assignment, you will turn it exactly equal to what I have, And so therefore, we're going to start out with the placeholder that this equals the previous year. Okay? Now, the second thing we're going to do is we're going to go to the income tab, and cell H1, we're going to say forecast. And in cell H2, we're going to say equals the previous year, so G2 plus 1. And in cell H3, we're going to forecast 2024 revenue. So here's how we're going to do this. 2024 revenue equals 23 revenue, so equals G3 times left parentheses 1 plus the growth rate. So 1 plus ratios 2024 growth rate, H3, right parentheses. So if they grow another 0.2%, they would grow to 27034.13. Now, I'm then going to select H2, go all the way down to H27, and format this to 1 decimal place, just to be consistent with the previous years. So I don't have to keep formatting every time. All right, so here's the point. The ratio creates the number. Don't do this. Here's what we're going to do in 2 weeks. If I go to Nvidia today, and I go to their EEO, the consensus estimate for next year for their sales for 2024 today is 54.5 billion. It's not 27 billion. Okay, they're expected to grow a lot. So here's what we're going to eventually do. That growth rate is 102.23%. Okay, so what's going to happen eventually is I'll come into my model, I'll change this ratio to 102.23, and that will change that to the 55 billion. Okay? The ratio creates the number, and we'll put in more realistic ratios. But we're not doing that today. Okay? What we're going to do today is, as we build the reusable model, is we're going to just say, whatever happened in 23 repeats itself to 2024, and then 2024 for the next 5 more years. Okay? Eventually, we'll put in more realistic numbers, but not today, because you got to match what I do. So I'm going to undo this, and the number you should have in your file is 27034.1. Okay? And by the way, you may wish, file save as, save this, because it would really suck if you build this template and Excel crashes on you in the middle of all of it, and then you lose all your work. So save frequently. It's my or auto save, even better. But long story short, we're going to continue building out the balance sheet, or sorry, income statement balance sheet. So back to ratios. The next ratio we are going to forecast is EBITDA as a percentage of sales, which is H7. So H7 equals H6, and that is going to be yellow. The next ratio we're going to forecast is H8. H8 equals G8. That is going to be yellow. Operating income, also known as EBIT, we're going to solve for. So H9 equals H7 minus H8, not yellow, because it's actually based on the 2 items above it. Now, if you want to see the pluses and minuses, look all the way over to the left. This is what we are adding and subtracting to create the income statement. 2 things. 1, formulas, not yellow. Okay? Now, 2 things. 1, we had to make a choice. Do we forecast EBITDA or do we forecast EBIT? We solve for the other, right? I am making a choice that we forecast EBITDA, okay? We forecast EBITDA, solve for EBIT. That's just the way the model is going to work. So EBITDA is going to be a critical forecast number. Choice number 2, to forecast EBITDA, we would have had to forecast these 3 items above to create our EBITDA, right? I am making a simplification in this class. The model doesn't care, all right? The model doesn't care about the cost of goods sold. The model doesn't care from a cash flow standpoint about the SG&A. The model cares about the EBITDA. So shortcut, we're forecasting EBITDA directly. If you worked at Goldman Sachs, you worked at Morgan Stanley, you worked at Deutsche Bank, you'd be forecasting every one of those. All right, you'd be forecasting cost of goods sold, you'd be forecasting SG&A, you'd be forecasting depreciation, and you'd make sure that they sync to your EBITDA forecast and your EBIT forecast. All right, I'm simplifying that for you guys. okay? Because number one doesn't really matter, but number two, it gets us a faster valuations. Questions? All right, next, we need to forecast a tax rate for 2024 equals the previous year. I know 4.5% is not going to be Nvidia's tax rate when they make as much money as they did this year, but nonetheless, we're going to leave it at negative 4.5% for now, yellow, equal previous year. No plat we solve for. If you click on cell G11, you'll see the formula, which is basically our operating income times 1 minus the tax rates, our no pat, okay? So if you want to be lazy, which I am, take the formula in cell G11, copy it, go to H11, paste it, and that would be operating income times 1 minus the tax rate. So I'll have to retype the formula. The final income statement ratio that we're going to forecast is non-operating gains and losses as a percentage of sales equals the previous year. So H12 equals G12. We're going to make that yellow. So very quickly, we have forecasted the key income statement items in yellow. Okay, and solve for a couple of others. Below that are the 11 balance sheet ratios we are going to forecast. Okay, every one of these ratios, with the exception of the revenue percentage change, is a percentage of sales. Okay, so same concept. Accounts receivable equals for H14, G14. Make that yellow. Okay, except here's what I'm going to do. I'm going to copy H14. I'm going to go all the way down to H23. I'm going to paste it. Because all just equals the previous year, right? So now I have all of these income statement ratios and all of these balance sheet ratios equaling the previous year that I'm going to forecast. And they're all yellow. Do you know why I'm just forecasting these 11 balance sheet ratios and those 5 or 6 income statement ratios and not the rest? Anybody want to guess? Why just these? Why not others? Yeah.
Aren't the balance sheet items like operating items?
Because these are all operating. Exactly. So what we're forecasting is the operating capital. What we're forecasting is the operating profit. That's the critical part to the free cash flow forecast. Everything else, noise. So we don't really need to worry about it. We're going to, but I'm telling you it's not critical to your valuation. So back to this. Take column H. And by the way, the last one on here, IC to sales, is a formula. Copy G24 to H24. This is IC as a percentage of sales. Now, we don't have a 2024 balance sheet, so we don't have 2024 invested capital, so the number's 0 right now. But what that cell is eventually going to be is in the ROIC tree, it's this number. It's this row. That's IC to sales. Okay? And I say, why is he putting that there in the ratios? Because when we forecast invested capital, right now, Nvidia's invested capital ratio is about 60 cents per dollar, which is row 012, 0.596. So when I forecast, I want them to still spend about 60 cents per dollar. So I don't want to have my balance sheet out of whack in the future versus what's a reasonable balance sheet for Nvidia. So using the historical invested capital sales, it gives me a sense of what's a reasonable invested capital to sales to forecast. That bottom line is like a sanity check. Okay, that's the final ratio. So once you've gotten to this point, take column H, copy the whole column, go to column M, select, paste. We have now forecasted 6 years of ratios, operating ratios, for the income statement and balance sheet for Nvidia, columns H through M, all equaling the previous year, which means they're just repeating 2023 for 6 times as our placeholder. So everybody at this point, any questions? How we got to this point? All right, once we get to this point, we're then going to build the actual income statements and balance sheets. And by the way, when I put in this file, I left over this extraneous stuff, row 26 and 27, just delete it. You don't need it for now. There's no share price in our model yet. All right. So, and the divide by zeros currently are okay because there is no balance sheet. All right. We're going to start with the income statement. Basically, based on those ratios, we're going to forecast the 2024 income statement. Starting with EBITDA, which is H8. So for 2024 EBITDA equals 2024 revenue, so H3, times, from the ratios, H7, which is EBITDA as a percentage of sales in 2024. That should give us a number, 5780.9. Okay, everybody with me? Okay, we're going to do the same thing. Depreciation and amortization equals, so H9, H3, 2024 revenue, times ratios, H8, 2024 depreciation as a percentage of sales, 1547.4. We're going to solve for the operating income. Equals EBITDA, H8, minus H9, depreciation, 4233.4 of operating income. So very quickly, we have just created a forecast for Nvidia's operating income and EBITDA for 2024, based on those ratios coming true. We have to finish up the income statement. I told you it doesn't matter as much the valuation, but we still have to forecast the income statement. So we're going to finish forecasting the income statement. The next item we're going to forecast is interest expense. One of the points McKinsey makes is that when you do an enterprise DCF, it assumes a target capital structure into the future. That's actually why you can use a constant WACC. Great midterm question. So the idea is we put in a target capital structure, constant WACC, which means we don't really change the debt and equity balance of the firm. That's one of the applied assumptions of an enterprise DCF valuation, right? Given that assumption, whatever debt the company has, we're going to leave alone. It won't affect the valuation, and we wouldn't be changing it too much anyways, given the target capital structure. By the way, if the company doesn't have a target capital structure, you have to create one, but that's beyond the event. That's more advanced than what we're going to do in this class. All right, interest expense. Therefore, if we're going to leave the debt alone, the interest payment should be about the same. So whatever interest they paid last year, they're going to pay next year. Won't change the valuation, but we need a placeholder. So for H11 equals G11. Same thing. If they earn interest income on cash balances, they're going to keep earning same levels of interest income on cash balances. So for H12 equals previous year. For FX gains and losses, I don't know what's going to happen to exchange rates. Neither do you. And most companies hedge. So for purposes of future FX, 0. We're going to assume they hedge and they don't have big gains and losses. If you actually ran into a company and you believed you knew what it was, you're always welcome to overwrite these. But the reason why I'm not putting them in yellow and I'm putting them here is I'm telling you they will have 0 impact on your valuation. Okay? So I don't want to just do extraneous things for window dressing that you don't have to worry about. This is the 90-10 valuation model. If you really wanted to get window dressing and get to every single line item forecasted individually for every single company, that's Sarah Cronke's class. Go take that. That's what they do in the SEMBIT fund. And I'm not saying it's bad. It just takes a heck of a lot more work. That's why in her class, they'll do one company for the entire semester, right? We'll do one company a week, right? Because I'm giving you what really matters to most valuations. There's always little nuances. You want to get there, you do this for reality. But for what we're doing, this is good enough, okay? So back to this. Income or loss from affiliates equals the previous year. H14 equals G14. Non-operating gains and losses. We're just going to leave whatever income or loss is the same. Non-operating gains or losses, that was a ratio. So for H15 equals 2024 revenue, H3, times ratios, non-operating gains and losses as a percentage of sales, H12, 48.1. Okay. Now we solve for pre-tax income. Again, look all the way to the left. You see the pluses and minuses. Pre-tax income is operating income minus interest expense plus interest income minus FX minus loss from affiliates minus non-operating gains and losses. That's the formula we need in that cell. Or if you want to be lazy, I already put that formula in G16. So take G16, copy it, 816, paste, 4190.3 is the pre-tax income for 2024 based on this forecast. Next, we need to figure out what taxes we pay on this pre-tax income. Equals that pre-tax income. So for H17, take H16 and multiply that by ratios, H24 tax rate, H10. So ratios H10. Negative 187.4. Now I know that they're not going to have a negative 5% tax rate next year given all this profit. So eventually we're going to put in a more realistic tax rate. But since it's a placeholder, that would be the negative taxes if that was the ratio. Does that make sense? So what is income before extraordinary items? It's pre-tax income minus tax. So again, equals H16 minus H17. So it'd be 4377.7. They'd essentially get a refund. Extraordinary loss net of tax, 0. By definition, extraordinary items should be like, didn't know it was going to happen, shouldn't recur, no idea it was coming. Well, when we're talking about the future, we shouldn't have extraordinary items that we forecast in the future if they're truly extraordinary. So therefore 0. Okay. Now I'm not saying that a company's not going to say, oh yeah, we're going to lay off 10,000 people and take this one-time charge, and you kind of know what the extraordinary item is for next year. But generally, extraordinary items 0. Don't know what they're going to be. Don't forecast them. Okay. Again, you can always change it, but I'll tell you, 0 impact to the valuation. Next, net income before minority interest. I'm going to be lazy. G18 minus G19, copy that. So copy G20. Paste that to H20. So 4377.7. Minority interest. Nvidia doesn't have any minority dividends they pay, but another company might. So just like the interest we're going to leave alone, we're going to leave the dividend payments alone. So for H21 equals G21, concept of reusable model. So again, net income, copy G22 to H22, paste. So 4377.7 after minority interest, which are 0 for Nvidia. Next, we have preferred dividends. Same concept. Because we're leaving the cap structure alone, we're not going to change any preferred stock, which means we're not changing any preferred dividends. If they had preferred dividends, they keep paying them. So for H23 equals G23. Other adjustments to equity, 0. These generally occur when the accounting rules changes. If there's a change in GAAP or IFRS, then that would force you to restate your numbers. Generally, these adjustments have no impact on cash flow. It's just it's accounting exercise the accountants like to do and get paid lots of money for, but they don't affect valuations. Right? If we knew what the accounting adjustments were, we might be able to forecast them, but we also don't know what they're going to be in the future typically. So they're not going to have a big impact on our valuation anyways, 0. Again, if any of these items I make 0, you think for an individual company are really critical and have to be forecasted, you're welcome to do it. But I'm telling you, they generally don't affect the valuations, especially when we talk about the future ones. 0. Net income available to common shareholders is H22 minus the 2 items above, or just to be lazy, take G25, copy it, go to H25, paste it. Right? Finally, dividends. Same concept as preferred, equals the previous year. They'll pay another $398 million in dividends next year. Not going to change dividend policy. Leaving cap structure alone. Solving for change of retained earnings. Net income minus dividends is change of retained earnings. That's how much retained earnings should change. But we have an issue. Another best practice to be aware of. The formula, which you can see in column A, is net income minus the dividends paid equals the change in the retained earnings. So theoretically, we should take H25, subtract H26 to get H27. However, if we were to do that, because H26 is a negative, subtracting a double negative would actually add the dividends, not subtract the dividends, and give us an incorrect result. This is why it's important to know your data source. This is why this model is only tied to Bloomberg, okay? Because what I know about Bloomberg is when they report income statement costs, cost of goods sold, SG&A, depreciation, They report those costs as positive numbers. On their statement of cash flow in Bloomberg, in their database, they report dividends as negative numbers. So I know from past history that Bloomberg's going to send me dividends as a negative number, not a positive number, even though it will send me income statement expenses as positive numbers. It's just the way their database is set up. So because I know dividends is going to be coming as a negative number, the formula for H27 is equals H25 plus the negative H26, 3979.7. So everybody understand why I did that? Why we're doing that? By the way, they do the same thing with preferred dividends. Nvidia doesn't have preferred dividends, but if they ever did, they would come to us as a negative number. So the reason why I asked you to take G25 and paste it to G26 is that formula is H22 plus H23, not minus, because I know it's coming as a negative number, minus H24. If you were to take this model and set it up with something else, CapIQ or whatever, it wouldn't work. Because CapIQ's database has data in a different format than Bloomberg's database. Plus the database fields would be different. So we are building a reusable model that's tied to Bloomberg. I just want you to be very aware of that. Questions? Okay. Now that we have forecasted the 2024 income statement, take all of column H and select it, copy it, go to column M, paste it, and we now have 6 years of forecasted income statements for Nvidia, assuming those ratios come true. And this is something you would have appreciated in homework 7. Go to your TII. Take column G on TII, which is 2023 TII, copy it, go select a column M, paste it. There are 6 years of forecasted balancing TIIs. Done. You have appreciated this for homework 7. You did this manually, the model's already done it for you because everything was a relative reference. So in less than 30 minutes, we have forecasted all of Nvidia's income statements and all of Nvidia's TIIs for the next 6 years. Is everybody at this point? Any questions about anything so far? Hope you've been able to follow along and get to this point. As I said, this class is being recorded, so you're always welcome to check the video if you missed something. Now we're going to forecast the balance sheet. Same concept. We have balance sheet ratios. So using those ratios as a percentage of sales, we're going to go to the balance sheet tab, and we're going to do a similar process that we did on the income statement. Okay. So column H1. This is my first year of forecast. H2 equals previous year plus 1, G2 plus 1. The first ratio as a percentage of sales in 2024 is accounts receivable, 14.2% of sales. So on the balance sheet tab, accounts and notes receivables row 6. So H6 equals, from the ratios tab, H14, accounts receivable as a percentage of sales in 2024, times, from the income tab, 2024 forecasted sales, H3, return, 3835.53. I'm going to take H4, select all the way down to H33, comma, 1 decimal place, just to match the previous formatting. So I have to do this every cell. It gets annoying. Okay, so you should have 3835.5. Same thing. Unbilled revenue equals, you're going to repeat this process 11 times, equals, for the ratios, unbilled revenue 2024, H15, times 2024 revenue, income tab, H3, 0. Nvidia doesn't have unbilled revenue, but another company might. So we're putting it in here. Next, inventories equals ratios, inventory as a percentage of sales, H16 times income, H3, 5170.5. Other current assets is the next ratio, equals ratios, H17 times income, H3, 2024 revenue, 792.8. Next, long-term investments equals ratios, H18, 0 for Nvidia, times income, H3, 0, but could be different for a different company. Net fixed assets equals ratios, H19 is a percentage of sales, times income, 24 sales, H3, 4855.8. Next, goodwill, skip, go to other long-term assets equals ratios. Other long-term assets is row 20, so H20, the ratios, times income, H3. The next line item is accounts payable. So for accounts payable as a percentage of sales equals ratios, H21 times income, H3. Other short-term liabilities equals ratios, H22 times income, H3. And then we have other long-term liabilities. It's row 24 here. Equals ratios, H23 times income, H3. $1917.3. So those are the operating items on the balance sheet, all as a percentage of sales, times the forecasted 2024 sales, turned into dollars for Nvidia. Questions about any of that so far? Everybody get to this point so far? All right, now what we're going to do is we're going to finish the balance sheet, get it to balance, and very importantly, not have a circular reference. Any Excel file you ever see that has a circular reference, you should be very skeptical of. It's an invalid file as far as I'm concerned. You can never, in this class, turn in a file with a circular reference. It won't be graded. You'll get a 0. Okay? So you cannot have a circular reference. So I'm going to show you how this auto-generated forecast will forecast without a circular reference. So this is what we need to do. We are going to finish by basically finishing the liabilities and equity side of the balance sheet first. Starting with short-term borrowings, which is H20. H20 equals G20, previous year. If we're not changing the capital structure, we're going to leave the debt alone. Whatever short-term debt they have, the short-term debt stays the same. Current liabilities can now be summed. It's the sum of the three above. It's the sum of the accounts payable, the short-term borrowings, and the other short-term liabilities. Add those three up, 6574.5. That's your current liabilities. Long-term borrowings, that's long-term debt. Same concept. If we're leaving the cap structure alone, leave the debt alone. Long-term debt equals the previous year. So H23 equals G23. Same thing. Pension liabilities, if they had any, H25 equals G25. Long-term liabilities, sum those three. Sum the long-term borrowings, Long-term liabilities and pension, H23 to H25. 12,522.3 of long-term liabilities. Total liabilities is current plus long-term. So H27 equals current liabilities, H22. Long-term liabilities plus H26, 19,096.7. Now we forecast equity. First one's preferred. Same concept. We're going to leave whatever preferred stock that they have outstanding, just like we're leaving the debt outstanding because we're not changing the cap structure. We're not issuing or retiring debt or equity. So equals preferred. H28 equals G28. Same thing with minority interest. Whatever minority stakes they have, they keep. They don't change the minority stakes. H29 equals G29. Share capital and APIC stands for additional paid-in capital. This is the common equity. Same thing. We're not issuing or repurchasing common stock in the future. Equals the current share capital. So H30 equals G30. The one thing we have to solve for is the retained earnings, right? From accounting, net income minus dividends is how much retained earnings should go up or down. That's just accounting 101. So here's how we're going to solve for retained earnings in 2024. So for H31 equals G31, last year's retained earnings, plus, from the income tab, H27, which is the net income minus the dividends, or how much retained earnings should go up or down. That's H27 off the income statement. So we're going to add that to last year's retained earnings. Income. $14,107.7. So if that income statement comes true, that's how much retained earnings should be at the end of next year. Total equity, sum the four above. Total equity is the sum of the preferred, the minority interest, the share capital, and the retained earnings. So basically H28 through H31. Total liabilities and equity equals, total liabilities is H27 plus total equity is H32, 45,177.4. So we've just finished forecasting the liabilities and equity side of Nvidia's balance sheet next year. It's very important that our balance sheet balance. So I'm going to show you best practice trick number 5. How do you make your balance sheet balance? Go to total assets, which is H16, equals H33. Balance sheet balances every time. Will always work. I know it's my poor finance humor that nobody's laughing at. But anyways, that's how you make your balance sheet balance. But here's the point. In order to make our balance sheet balance, all of the assets above have to sum to that number, which means one of those numbers is going to be what we call plug. We're going to solve for one item to make sure the balance sheet balances. The plug is excess cash. So excess cash is the plug in our model, which will make the balance sheet balance. Okay? So that means if excess cash is our plug, I need to forecast the other things that are not excess cash, starting with operating cash. So I need a forecast for operating cash for Nvidia in 2024. Here's how we're going to do it. Equals, we said when you built Homework 7 that, and the custom formulas, operating cash is 2% of revenue. Okay? So equals for 2024, revenue, income, H3, 2024 revenue, times assumptions, B3, which is operating cash as a percentage of revenue. Okay? And then you hit enter. 540.7. Now you might say, gee, why did he put operating cash on the assumptions tab and not on the ratios tab? And it goes back to ratios can change year by year. Assumptions are universal across the years. We're not going to change the operating cash as a percentage of revenue assumption. That's why it's on the assumptions tab. Okay? So when I copy and paste it, though, it's going to cause a problem, because when I copy and paste, which we're going to do in a minute, it's going to take assumptions B3 across the columns, C3, D3, E3, F3, and there's no numbers over there. So the other thing I need to do is edit that formula, and in front of my B, put a $sign, and in front of the 3, put a $sign, and that's going to tell Excel that when I copy and paste, to make it an absolute reference to B3 and never change it, regardless of where I copy and paste. It's a very important step. The final item we need to forecast is goodwill, besides excess cash, which we're going to plug for. Equals the previous year. Same concept. I don't know who Nvidia is going to buy in the future. I don't even think Nvidia knows who they're going to buy in the future, so we can't really forecast it. And technically, acquisitions in the future don't matter that much because most companies don't make any money on acquisitions. At best case, most acquisitions tend to be NPV 0. That's what the academic studies say. So I'm not going to really worry about acquisitions in the future that we don't know of and how much value they could potentially create. They don't generally create value. So whatever goodwill they have, we're just going to keep, right? So back to this. I then have excess cash as the only line item that I haven't forecasted. Here we solve. So here's how we solve for H5. Equals total assets, which is 816, minus everything else. So 816 minus H4, operating cash, minus H6, accounts receivable, minus H7, unbilled revenue, minus H8, inventory, minus H9, other current assets, minus H11, long-term investments, minus H12, net fixed assets, minus H13, goodwill, minus H14, other long-term assets. Hit enter, you get 16,702 of excess cash, and more importantly, no circular reference. So if you want to see this, it's basically just 816 minus every other asset category. Just being subtracted. That's how we plug for excess cash. Questions? We're in the home stretch for today. All right, so finally, we can now go to current assets. Sum, everything above. So current assets, which is H10, equals the sum of H4 to H9, 27041.6. Long-term assets equals sum from H11 to H14, 18,135.9. If you want to do a quick check, take your current assets, add the current liability or current long-term assets, H10 plus H15, 45,177.4. So I'm getting the number by adding up the assets that equals the number by equaling the liabilities and equity, my balance sheet balances. Questions? All right, so take column H, which you just built, select the whole column, copy column H, select a column M, paste. We now have 6 years of forecasted balance sheets. Go to your TFI, take column G, copy, go to column M, paste. We now have 6 years of forecasted and balancing TFIs. The only change is starting in year 2024, this is now a forecast. Go to our CFI, take column G, copy, go to column M, paste. We now have 6 years of forecasting and balancing CFIs for Nvidia, in addition to our 6 years of historical CFIs, which balance. Again, these are now forecast, so I'm going to add the word forecast, which I forgot to do on my TFI as well, from I1 H1 to M1, this is my forecast. And on my CFI from H to M, so make sure H and the TII was a forecast. There we go. So I now have 6 years of balancing CFIs. Right? Save. If you've gotten to this point, you don't have any more things to do between now and 2 weeks from today. If you haven't gotten to this point, by 2 weeks from today, you have to get to this point. Okay? Because we're going to start right here and continue building the valuation model, because we're not done. All right? But what we have done today is we have built a model based on Nvidia, actual data, that forecasts 6 years of financial statements and 6 years of economic statements, and more importantly, 6 years of cash flow. And we've built it in a reusable way so we can put any company's data into this model and it will do the same thing instantaneously. Okay? Now, here's where we're going to go 2 weeks from today. So again, you need to save this file or get to this point. 2 weeks from today, we're going to pick up right here and we're going to turn this into an enterprise DCF. And then right after that, we're going to talk about how to make that enterprise DCF more dynamic to represent what's really happening to Nvidia, and then get into the real parts of the valuation. That's the art of valuation, right? But nonetheless, that's where we're going next. Questions? Anything we've done here today? Anyone want to see any cells? Look at anything? Please either see now. This has been recorded, so it will be posted on YouTube if you want to go back and check this. But here's the point. Next Monday, you guys have to do Tesla, right? I'm giving you, in a way, a break. Your teams can make a choice. Choice number one with Tesla, because I gave you the Tesla data, okay, the income statement and balance sheet data. I didn't give you the raw data, but I gave you the income statement and balance sheet data. You can either use your homework 7 to create the CFIs and ROIC trees for Tesla, which you're going to be presenting for a grade 1 week from today, or technically you could use this model. Because even though I didn't give you the raw data for Tesla, you could put in the income tab and the balance sheet tab the historical Tesla data, and everything else would flow through historically, including building the tree and building the CFI. Okay? So one of those two things has to happen between now and next Monday. Okay? So if your team is concerned that we're not really sure whether our model really works and whether it's not really right, you could use this. Okay? Because what you're going to be presenting is not this, you're presenting the final results, which have to be right. Now, my data for Tesla is coming from here, so I know it's right. So if you're giving data that's different than what I do for right next Monday, I will deduct it from your grade. You can't give me incorrect data that you're presenting on. But nonetheless, you're presenting the ROIC tree and CFI for Tesla 1 week from today. That's your historical team presentation. No, 5 days from today. That's next Monday. 1 week from today, you're taking your midterm exam, okay? And then 2 weeks from today, we'll continue building out the valuation model. Where's the sign-in sheet? Did everybody sign the sign-in sheet? If you haven't, please sign before you have today. Remember, TAs have office hours next 2 days. This file is going to be on YouTube. See you guys on Monday. One second. Okay, I want to stop the.
So the group case is on Tesla, and then homework 8, is that on Amazon or Tesla?
Which one? The group case?
Homework 8, so the week after.
I'm going to change that homework, so don't pay attention to it.
Oh, okay, so just focus on
Just focus on Tesla.
Okay, thank you.
Fuck.
That's like 16.
Are they checking? You have to go to class. What's this one? What do you have?
Did my